Hello, good afternoon, and thank you for joining to the next panel in private debt. I'm delighted to welcome you as a moderator of this panel. My name is Gabriela Kindet. I'm a non-executive director at various organizations, and we have a very exciting panel to talk about next frontier leverage. And it's actually a quite broad subject because we are going to cover first junior debt and subordinated debt, followed by NAV financing and secondaries. So before I start with the first subject, maybe we can start with Abik from left to right to introduce yourself. So why are you here today? What is your relevance of the subject? And where are you in the echo chain of the very complex universe of private debt?
Sure. Thank you very much, Gabriela, and good afternoon to everyone. My name is Abik Das. I represent Three Hills Capital Partners. Three Hills is a firm that was established in 2012 really to support founder, owner, managed businesses with growth capital, typically businesses that either are going through a shareholder transition or need growth capital for acquisitions, for M&A, for other sort of organic growth opportunities. And we're currently investing at our fourth fund and invest across Europe and a little bit in North America as well.
Excellent. Thank you, Abik. Fokke?
Hi, Fokke Lucas. I'm a partner at 17 Capital. We provide NAV financing for private equity portfolios. We do that across the price risk spectrum. We do it with our strategic lending fund with preferred equity. We do it with our credit fund. And we provide NAV financing at portfolio level. We manage around 11 billion. We invest globally, and we're about 70 people in two offices in Europe and in New York.
Thank you. Francesco?
Yeah, good afternoon, everyone. Thank you for being here at this late hour. Francesco Di Valmarana. I'm a partner with the investment team at Pantheon. Pantheon's a large private markets investor. We invest in primaries, secondaries, and co-investments across private equity, private infrastructure, and private debt. In the context, I guess, of this panel, we are predominantly secondary providers of liquidity in the private debt markets, both in an LP position, classic secondaries, but also GP liquidity solutions, which have very different flavor in private debt than they do to private equity. We have about $90 billion under management globally, secondaries across the asset classes, about 25 or so, and in private debt specifically, we're about 6.5.
Thank you so much. Franklin?
Good afternoon, everyone. Franklin Rowe. I'm a partner at MBO & Co., a long-standing private equity investor in the French low mid-market. And I'm part of a newly formed Flex investment strategy where we focus on flexible capital solution for French low mid-market businesses. We are typically instrument agnostic, but we mainly invest through junior capital and also equity.
Okay.
Hello everyone, Laurent Warlop, Indigo Capital. Indigo Capital also is a long-standing player in the junior debt and I would say subordinated debt market. We've been around for 20 years. We are focusing in management-led transactions, so backing entrepreneurs, managers, and family, which are always the majority shareholders, in the context of capital organization or expansion projects. Well, we invest mostly in subordinated debt products with a systematic access to equity upside. We are focusing on the smaller end of the market, EV ranging from 30 to 200 million euros. We have an office in Paris, Lyon, and Milan. So we do most of our business in France, but we are also active in Italy.
Okay, thank you. So let's talk about some trends and some significance of the first subject, which is junior debt. So we try to get some statistics, how important it is. So if I look at the European market, the size of the European market, it seems that approximately 35 billion. So if we think that the private debt market is somewhere around 250 billion today, you can calculate that approximately 10-15% is junior financing. It has grown quite significantly in the last 5 years, like 25% annual growth, but a lot less than in the US, because in the US it's a lot more significant, and I mean the US market is 130 billion, so proportionally slightly higher than in Europe, and it has grown significantly, like 70%. So as we know, very often the European market is following the US trends. Abik, what can you say about the trends, and how do you see what drives the growth of the European market?
Well, I mean, there's been a lot of growth in the private credit business in general, but I think if we focus on what we provide and some of the other panelists provide, we provide more of a niche, I'd say, something that sits between classic senior debt and equity provided by private equity firms. Speaking for Three Hills specifically, we typically partner with founders, with founder-owner managed businesses that don't want dilution. So they are really buyers of their own businesses. They're not looking for the next cash out, and we support them in that situation. If a founder or owner wants to cash out, there are tons of private equity firms that will buy control and essentially buy their asset. We provide something that sits in between, and so it becomes more difficult, I guess, from an explanation perspective, because we are sitting in between classic debt and classic equity. Now, I think in terms of your specific question, why is there more growth in this space, and I think why are we seeing a lot of interest, both from a supply side, but also from a demand side, both from LPs, but also from companies that we're looking to invest in. I think it really is because we are providing something that is an alternative, and there is a middle ground where people are looking for something that is not necessarily just senior debt, but also not really looking to cede control. And as that asset class, probably sub-asset class, gets more established and people hear more about this asset class, it's become more prevalent, I'd say, and hence, and also looking across the pond to the US and seeing that a lot of that there's been a lot of capital formation in this specific space means that I think it's only time will tell, of course, but I think it's only a matter of time before we'll see a lot more capital formation here in Europe as well.
Excellent. Couple of short questions to those people representing Julian Capital here. What is the percentage of sponsor-led transactions in the portfolio?
In our portfolio?
Yes.
Oh, it's like 80%, 85%.
So you are mostly sponsor-driven?
Clearly, yeah.
Mm-hmm.
No, we are more sponsor-less focused strategy, but we do make some room for sponsor deals.
So 80%?
Two-thirds, one-third, two-thirds sponsor-less, one-third sponsor.
Abik?
Close to zero, so primarily a sponsor-less strategy.
Okay, just in the context in Europe, as you know, 80% of the private debt transactions are sponsor-driven and 20% are non-sponsored. So there's a space for everybody. I just want to make sure that we understand the landscape a bit. You mentioned you are mostly doing sponsor-driven strategies. Can you say?
Sponsorless.
Sorry, it's 80% sponsorless.
Yeah,
okay,
yeah.
80% sponsorless. Second question is, what is the return profile of your portfolio? Maybe we can start with you, Abik. Sorry for spotting you in the spotlight all the time.
We're targeting net returns of 15%. We've delivered so far for our LPs and targeting roughly a money multiple of 2 times. I think, look, it is a very hands-on strategy. We sit on the board of these companies. We support them where needed, of course. Not every company needs the same level of support, but those that need that support, we go in with our value creation team. We help with digital projects, with HR. We obviously help them from a corporate finance perspective. I think not too dissimilar to some others. Everything from financing arrangements to M&A to everything else. But it is fair to say that it is a very hands-on strategy, which is why we obviously command a certain premium, but we also need to obviously deliver for our LPs, and to date we've luckily managed to do so.
Another short question from LP's perspective. So you are offering coupons, so it's not rolled up interest, but you are offering cash coupons, yeah? So from the 15% return, what is the cash element?
It varies depending on the deal. I mean, in the current market environment, we're able to get slightly higher cash interest on some of our transactions. Now, because we often co-invest in the equity alongside the founders, the owners of these businesses, we're obviously aligned. So we're also not trying to burden them with too much cash interest. So usually it's a flexible combination between cash and PIK. But it is fair to say that we are trying to generate a healthy single-digit cash yield for our investors.
Okay. So no answer to my question. How about maybe we can continue?
So we're targeting slightly lower returns.
Lower.
With a more private debt focus, I would say. And because we're part of a global platform and we have a private equity strategy.
And how low? So 15?
So we're looking for more 16% gross return, 1.7, 1.8 gross. So not miles away from what ABIC is doing, but slightly more private debt angle to the strategy. But we are also very active investors. So we are systematically present at board level, and we act as sparring partners of management team on topics that ABIC mentioned, M&A, governance, professionalization, talent management, etc., etc.
Yeah, so it's a very different approach. You're very close to the company. You're sitting in a board. You are minority interest, basically, almost.
Yeah.
So how about you?
Yeah, well, like high teens return, that's what we're targeting.
How much?
High teens. High teens.
High teens.
returns.
High teens.
So 15% and above.
And cash?
The cash coupon, I would say it's generally we try to generate a 4% cash coupon. If we target a 10% plus interest rate between 10 and 12, that's what we are targeting, plus warrants on top, plus sometimes equity ticket as a minority shareholder as well. So generally speaking, yeah, the cash coupon will be around 4-5%.
Okay, excellent. So let's move to risks, alignment of interest and risk mitigation, you know. So how do you make sure that you mitigate risk? So how do these transactions look like in terms of enterprise value and the equity buffer you have? So maybe I'm not going to pick on you, Abe, can start with you. Maybe we can start with you. So how does a typical capital structure look like?
Yeah, sure, but it depends. On sponsorless transaction, we typically have no to moderate leverage. And we have high equity buffer ahead of us.
How high?
It depends. Can be 50%, can be 70%. It depends of the transaction. How deep in the capital structure we are. And for sponsor deals, I would say 6 to 12 months ago, we were providing roughly a turn of junior debt. After 4 turn of senior. That's typically the leverage we will see on high quality assets on the lower mid market.
So and enterprise value 10 times.
So 10 times, 4 times senior debt, 1 turn of junior capital. That's on a sponsor transaction. These leverage level have now come down.
Yeah.
We see senior level more towards 3 to 4 times. So there is also an opportunity on the sponsor side to plug the financing gap that we see from time to time.
Excellent, very interesting. So if you think about it, that you get 50% loan to value and 15% return. Are you sure about your calculation of enterprise value?
That's on sponsor deals, there is a transaction. But no, to be fair, in the past we've been able to get these return on some quite conservative variation, because we do provide, as we all mentioned, we do provide something different. We provide less dilutive solution to entrepreneurs who are buyers of the business plan.
Yes, they want to protect their interest. Yeah.
They want to limit their dilution. So they have 2 options on the sponsorless side. They can either relinquish control to private equity investors, or they can't limit their dilution with quasi-equity.
Yeah, to put this into the context, I have not seen many statistics on the sponsorless and non-sponsor discussion, because it's really extremely difficult to compare apples with pears and But I have seen some interesting statistics recently from, I don't know whether I can mention, but Stepstone came up with some interesting statistics that to prove that actually sponsorless transactions, if you look at thousands of transactions in Europe, sponsorless transactions offer better risk-adjusted return than sponsor-driven transactions. And the very simple explanation they came up with was that sponsors are squeezing the debt providers, and there are so many, and they make sure that they have the best leverage terms. So just to put this in the context. So what can you say about this?
Yeah, no, I agree, because we are backing in sponsorless transactions. We are backing managers or family. They have all their wealth basically in the company, so they don't want to put that at risk. So they are very, very cautious on the leverage side. In our portfolio, I think the average senior leverage ratio is at 2.5, which is quite low.
Yeah, absolutely.
So it's true, we are focusing on primary deals and the smaller end of the market, but still it's clearly low, it's conservative, and it reflects the cautiousness basically of the shareholders, which are managers, entrepreneurs, and families basically. So I think it's a strong point for sponsorless deals. And on top of that, we add layers of subordinated bonds.
Yeah.
Generally 1 or 2 layers. One is senior with a second ranking security package. We have covenants. We have even off defaults. So we have a clear downside protection.
Yeah.
And the idea is to have a good risk-return ratio.
Yeah. You know, if I speak with LPs, one of the reasons they mention when they like sponsor-driven transactions is the clear exit. That's what they very often say. So what can you say to these skeptics, Avik?
Yeah, look, obviously there are benefits of sponsor-driven transactions, and there is a huge market for that. So I don't think any of us is saying anything against sponsor-driven transactions. But I think to add to the point that the two gentlemen mentioned in terms of our conservative capital structures, we typically sit behind maximum 1 to 1.5 turns of senior debt. And I think that's extremely important if you think about the downside and especially how you manage risk in a downturn. We really control our own destiny. We typically provide the largest portion of the capital structure, as I said, sitting behind 1 to 1.5 turns of senior. We will provide that vast majority of the capital structure and are usually the first institutional capital provider for these businesses. And so just to your question specifically, most of the companies that we back are in growth mode. They want capital to facilitate that further growth, but they are obviously looking for capital. And 2, 3, 4, 5 years down the line, they are looking for that next sort of exit or that next sort of situation. So usually it's a relatively easy discussion. I mean, I'm saying relatively easy. Obviously, these discussions are never easy. That we can actually manage an exit after 4 or 5 years. And we typically have step-in rights in our documentation. We have the ability to control an exit process. We have the ability to start an exit process after a certain period of time, usually in conjunction with the management. And in some cases, actually the founders or owners buy back our stake because they've had a very successful run or have had a lot of cash generation. So I'm not saying these discussions are easy, but that is ultimately our job, to make sure that we obviously return the capital of our investors, not just through the fixed income, but also through the equity as well.
Gabriela, can I reflect on your comment on Stepstone? I thought it was an interesting one because I think if you as an LP looking at the markets, the two questions I would ask there is, first of all, what's the time frame of reference? Because I think it's very difficult to draw any conclusions over the past 10 or 12 years. The other thing I would say is that within the sponsor-backed senior debt world, there's an entirely different risk-return curve, I think, between the larger transactions, which are heavily negotiated, and the more mid-cap and small-cap transactions, which are often bilateral. So,
Of course. I mean, that's why it's so difficult to come up with statistics, because are you comparing Apple with peer or whatever? Very good. So don't forget the sponsorless field and the junior transactions. I personally think it's extremely interesting, risk-adjusted return profile. And if you look at the trends, the climate challenges we have and how many SME companies need to transform their businesses, the way how they will transform their businesses and finance CapEx most likely be predominantly via junior capital financing. Yeah, so I think it's a huge opportunity to go ahead, and I think ahead of us. So I think you also have a strong influence in ESG and processes and how companies are changing, if I understand correctly.
Yeah, we participate to the boards of companies. We are board member, so we have clearly an influence in that regard. So obviously, the ESG aspect is important. I think all the managers, even in SMEs, the ESG aspect for them is key. Everybody has integrated that in their day-to-day business, I think. So it's kind of an easy discussion to have with the managers during the boards. And indeed, if there are capex or expansion programs to be made, junior capital is an interesting alternative because of the lesser dilution for the managers. Yeah, clearly.
Excellent, thank you. So if you allow me, for the interest of time, let's move to NAV financing, and maybe you can say about the market trends and growth expectations. This is something I've never heard about 5 years ago, but now it's becoming, you just drop names like 5 billion you want to raise. So tell us something about the trends and why do you exist?
Yeah, well,
not as a person.
It's why do I exist? You gotta ask my parents, right? I don't know if we want to know that, but yeah. Look, the technology that I think NAV financiers use is very similar to what we were just discussing, right? So there is financing at company level, at senior level, at subordinated level, and that didn't really exist at portfolio level. You could either sell your assets. Or keep them. And the NAV financiers, as we provide financing at portfolio level. So how big is the market? We look, at 17 Capital, we only invest in Europe and North America. If you look at the addressable market, we look at the net asset value. Ultimately, we finance net asset value that sits in buyout funds. And we estimate or guesstimate that's about $1.6 trillion. So that's the addressable market almost. You can finance at $1.6 trillion. At 17 Capital, we are expecting this market to grow up to around 70 billion per annum by 2030. And that is across the risk-return spectrum. So that includes preferred equity financing at higher risk, and it includes NAV financing at a slightly lower risk. And for that, there's a lot of a need for further capital, and that's what 17 Capital and some others are raising right now.
Okay, so let's just assume I'm an LP and I want to invest 500 million in this strategy. What should I do? What are my considerations? What should be the most important 3 questions to a GP like you?
I think, as with private debt investors, I think you need to consider where do you want to deploy the capital in terms of risk and where do you want to deploy it in terms of return. You can find...
Okay, so I want Europe and I want 6%.
Then you got to look at something else because we deliver a little bit more than 6%. Yeah, so just to give you a little bit of sense of returns, that was a question that was asked here on the panel. So our strategic lending strategy targets returns that are very similar, I think, to the other gentleman here. So at the moment, we're not underwriting anything below 15% that I see right now. So gross returns sit 15 to 20%. On the NAV lending, which is our lower risk, we're seeing 7 over plus some returns. So you're looking almost at a 10-11% net return for the credit fund 1 right now.
Very interesting. So what are my risks?
I think risk is at our strategy mitigated through diversification. But clearly the risk is if companies don't get sold by the managers. We invest ultimately with private equity managers. Like you are on the secondary. I think there are a lot of parallels as well on the secondary side. The risk is that the companies that are held with a buyout fund by a buyout manager are badly managed or face headwinds that they don't return capital for the limited partners. So one way of how we look at our risk profile is that we are a de-risked limited partner. So if the LPs, that generally speaking commit to buyout funds, what is the risk that you don't get cost back out of a buyout fund? You assume that's here, then we provide with our strategic lending 50% LTV of that risk, and with our NAV credit fund 20% LTV risk on that.
Okay, very interesting. Thank you. So, in our preparation call, you mentioned that it's very important to find a GP that can deploy.
Did I?
Okay.
Well, look.
So how do
I
you
think
find investment opportunities?
Well, how do you find? Well,
Yeah.
I think there are two reasons why managers attract NAV lending. One is to distribute to shareholders, and two is to invest more in the portfolio.
Yeah.
Now, if you want to distribute to your shareholders, increase DPI, or perhaps it's at the management company level. We also invest at management company level at 17 Capital. Could be to buy out shareholders or arrange a shareholder a change in shareholders. There's less need to invest in new opportunities. If it's money into the portfolio, then clearly it's generally used for add-ons. So managers use it in the current environment to create additional capacity at the fund level to fund the add-on opportunities that the current environment proposes, whilst there's less recyclable distributions, for instance.
Very interesting.
And Gabriela, if I can just add to your previous question, I think one thing, and maybe Fokke and Francesco can't say this for themselves, but if I were an LP and I looked at 17 Capital or Pantheon, I would say, who are the people actually who are making these investment decisions? And here you have two people who have actually done direct investing. And I think a lot of the people who are looking at these portfolio trades have actually done direct investing. I think that's extremely important. They have the experience of having looked at these underlying deals, can actually underwrite the single asset risk, and I think that's extremely important, which not all of the players in the field can do.
Exactly. So it's like fund-of-fund investments. You need to know what you are talking about. You need to do the investments to ask the right questions. Very good. And this additional liquidity for adds-on can be quite important if you want to maximize the quality of your portfolio as well.
Absolutely. And I think that drives partially, I think, also the volumes on the secondary market, clearly on the GP LEDs. It depends on whether that is across the whole portfolio or it's sometimes a bit more concentrated. We always like to think horses for courses. You have situations that can be addressed with single company financing. There are situations that can be addressed through a GP-led single asset secondary sales, and there are situations that can be better addressed with a financing at the fund level.
Absolutely. Thank you. So the floor is yours, Francesco, to talk about secondaries. I mean, I have seen so many headlines in the last couple of weeks about the billions of fund sizes raised recently. So tell us about it. What drives this huge interest?
So fortunately, not in our part of the market. Secondaries, of course, is a technology that's been around for 35, 40 years now in private equity, since about 2010 in infrastructure. But in private debt, really, it's very young. I mean, if you look at the statistics, what you'll see is that we in our industry have been doing secondaries in mezzanine distressed turnaround since the dawn of private equity. But you didn't really have senior debt funds until the GFC. You had a few here and there, but it was really the financial crisis that caused the banks to pull back, funds to step forward. And if you look at the fundraising statistics, what you see is that growth in LP structures, LPGP structures in debt, be it senior or junior, of course, has gone one direction over the past 15 years. And over the past 6 years, it's been somewhere between $150 and $200 billion a year. So talk of the market opportunity, if you look at NAV in debt funds, be it senior or junior, sitting on the books of institutions like our LPs, it's about 1.5 trillion right now. That's a big number. Yeah. And what we also see is that the propensity to use the secondary market to seek liquidity or to rebalance portfolios has gone from nearly negligible a couple of years ago to somewhere around 1 and 1.5% of that market. Bear in mind, private equity right now is north of 2%, infrastructure somewhere about 1.5%. So we're catching up in private debt world. What is interesting from an LP's standpoint, investing in these things we're doing, is the visibility you get across a secondary, be it private equity, infrastructure, private debt, right? It means you can avoid challenged funds, challenged sectors, teams that aren't any good, et cetera, et cetera.
Why are you looking at Abik?
Because, to his point about the people in whom you're investing. By the way, we're an LP in their fund. So, but it's key. You don't have the upside in a senior debt secondary that you have in private equity. So it's all about avoiding the downside.
Yeah.
And it's about using diversification across a broad portfolio to do it. It's about avoiding making the mistakes. And then using the discounts of the secondary market to generate a premium return. But the mentality as you come into it is minimize the risk and then give a slightly better return. So, everybody's been asked what their target returns are. I'll talk about before rates changed. We were probably looking to provide somewhere between net 7 to 9% versus if you were in a senior debt fund unlevered in Europe, we were getting 5 to 6. And in our credit ops fund, we were probably looking for something that was more like 12 or so, give or take, right, 11 to 13. And then post change in the financial world, you can add anywhere between 4 and 5 points to that because you have the base rate come up, you also have the spreads widen. So it's a very attractive alternative. It's for a LP who's investing in senior debt or in debt generally, it's a great add-on to a fund managed by the gentleman here. I wouldn't say it replaces them.
No, absolutely. And actually, you know what you get, because one of the issues in primary is that you ramp up a fund, you still need to deploy, you don't, or you need deployment time, you don't get carry. Here you have visibility and you get carry immediately.
That's exactly right.
Yeah.
Well, I wouldn't say you get carry immediately because it's like any fund. It's European carry. You have to take some time to get there. I would, if I look at it not just from the investor in secondaries, but what are secondaries providing to the market, because that's what I think, we're a bit a strange fish in this community. Because not only are we replacing limited partners in a classic fund structure, and that I think everybody can understand, but the whole GP-led thing in debt is very different from private equity. Right? Private equity tends to be continuation vehicles with 1, 2, 3 companies, highly concentrated around, quote unquote, the best, depends a bit on the portfolio. In private debt, what we're doing is effectively re-equitizing entire vehicles. So it might be an SMA, it might be an evergreen fund, it might be a BDC in the US. You can buy a strip of funds, of loans out of that, put it in an SPV, and then that vehicle can continue to invest. And the nice thing is in the world of evergreen funds, you can do this trade time and time and time again, and it really provides a useful service to that GP.
Thank you, but you must have an incredible statistics about GPs, strategies, risks, and return. Please share us some insight about performance, what you expect.
The Pantheon funds were a top quartile, no?
Yes, of course. Top decile. Top decile. Right.
Where is the best risk-adjusted return right now?
How do you answer that question? It depends entirely on what your risk appetite is. If you're a German insurer, you're going to have, and you're governed by solvency, you're going to be at one end of the spectrum. If you're a U.S. institutional investor, you're going to be at the other end of the spectrum. And what we're trying to do is provide different entry points along that spectrum.
But you know how you answer this question? You answer it by answering the question, because the fact is that return means very different things to different investors, provided what are their capital constraints. An insurance company may have a totally different risk-adjusted return than a pension fund or a family office. Yeah?
Correct. And that's what makes it interesting. It means it becomes a little bit more complex in that you can't have one monolithic investment vehicle. I guess you can. Some of our competitors do it, but we feel it's not appropriate to. So we've got one type of vehicle for one flavor of investor, another vehicle for another flavor, and et cetera, et cetera. And that allows investors then to pick where they want to be on that risk-return spectrum. It allows us, as a buyer of secondaries, in what is a quite young market right now. I mean, you can count almost on one hand groups that are focused on debt secondaries. Everybody dips into them, but groups that actually put out a sign saying we're going to do that. It means that we can go into a transaction that covers everything from unlevered senior European to the strangest credit ops and we can buy the whole portfolio. And in fact, of course, Pantheon has a big private equity secondaries business, a big infrastructure secondaries business, so we can take a portfolio across multiple assets as well. I think that single solution is an interesting one. Intermediaries in the market are very good at creating matrices. On the other hand, as things get a bit more complex, having fewer parties against whom you have to negotiate is also helpful.
Yeah. Very good. So, do you want to share some insight about how you select, what sort of, how you purchase? You know, you just raised funds. It's public information. So
Yeah,
how do you start your work?
It's a secondary fund. So,
Yeah.
I mean, and different, coming back to the question of the points you gentlemen raised, is I don't think you can do this on a top-down basis. So our DNA is as primary investors, and therefore you identify the teams you would like to work with in the context of a primary or secondary or co-investment ahead of time. You put in the time, you go out, you meet with them, you explain what you're doing, and say, should a secondary come along, we'd like you to prefer us. Now, of course, GPs still have transfer rights. They generally don't exercise them, but there's some out there who do so very much, and putting in the time makes a big difference there. Once you've built effectively your buy list and a wish list, then you put on top of that a portfolio construction. We're not going to get too much of X and too much of Y. We're going to have a pricing of Z. And you then go through what is a tremendous amount of deal flow. And the interesting statistics there, and I think you don't see it from the Evercores and the groups like that in the market because they only see a small portion of it. We started out from about 1 billion or so in 2015 of deal flow in debt funds across senior and junior. Last year we were at 22 billion. And I think if you were to add up us and Tikehau and Apollo and Collar and everybody who said they're doing this, you'd struggle to get beyond 5 or 6 billion in capital to buy that 22 billion. And that's what makes it quite an interesting market right now.
Yeah. Very interesting. Do you have any comments, Lucas, on the top-down, bottom-up and relationship that you develop? Do you have your wish list and buy list as well?
We have a strategy that is, we invest generally speaking with larger fund managers. So we like to deploy 100 million at least in every transaction that we structure. I think the average last year was about 300. We deployed across the two strategies a little bit more than 4 billion.
So by default, it cannot be a small player.
Yes, so you need ultimately a fund that has at least a NAV of, $1 billion plus. We structured one transaction last year that was $1 billion. So size tends to matter, which reduces the universe a little bit. On the flip side, it also is quite helpful because our market is very bilateral. It's not very intermediated. So it reduces the number of people you actually have to speak to and to build a relationship with, because our sourcing is very much built on a partnership approach. So we build a long-standing partnership with a select group of managers, which tend to be, again, the larger managers. So yeah.
Do you have hopes for smaller managers who also want to do something like this?
I think, yes. I think there is like every market, it generally speaking tends to start at the smaller end.
And you started 5 billion.
Well, our first fund was 88 million.
88 million.
88. We're currently raising fund 6, that's 5.5. Now, it's a little bit difficult to do bilateral, bespoke transactions of 5 million in a 5.5 billion fund. So ultimately, the market will develop. There will be new entrants that will do smaller transactions as well. So there's definitely, I don't want to call it hope, but it's the market is pretty efficient, right?
No, but there might be some entering opportunities also for other players who would like to start with a 100 million fund.
Absolutely, and the returns are good. We get on the NAV lending on the credit side, we get kind of investment grade risk, and it yields 11-12% at the moment, and we're distributing to your point about 6% of it per annum in cash. So it's an attractive proposition. We particularly see it on the insurance side, because ratings and return are particularly interested for insurers on Solvency II.
Because you rate your transactions, yeah? So return on solvency.
On the credit, yeah.
What is the rating rating range you are?
Investment grade. So
Investment grade. So it's super interesting to get a 7%.
a little bit more.
Even more,
It's,
I'm just
so our target
conservative.
returns are kind of, we're 7 to 9, but to your point on the raising rates and the increased spreads, we're going to be 9 to 10 or 11.
Let's hope we are not getting there, please.
Sorry, on the base rates.
Yeah.
No, but it's the
Yeah,
margin
yeah.
that we charge over the
I
base
hope
rates,
it's
right?
going the other way.
Okay.
It's interesting. So you use the rating, and we tend to focus much more on small mid-cap funds. And even with a program which is several billion in size, in a secondary context, you can do that because you buy a portfolio with several funds in it. There, what we benefit from, of course, is the super short duration.
Yeah.
And therefore, you apply the solvency calculation to it, and you're buying unlevered funds with only 3 years left in them, and we can deliver a similar type solvency weighting for that kind of return profile.
Yeah, exactly. So you are below 5 years, and which is again the threshold. Very interesting for insurance
we're well
companies.
below that. Yeah.
Exactly.
But I think the important thing with all of this is if you're an LP who's new to the asset class or relatively new to the asset class, all of these technicalities or very specific things that Francesco and Fokke have been talking about, I think the bottom line is it's good for the market. I mean, these are additional liquidity options that an LP has. It shows that the market is more mature, that the European private credit market is more mature. I mean, going back to what Francesco said in terms of private equity and secondaries being around in private equity forever, the fact that we now have several options from a secondaries perspective in the private credit space is a good thing. And I think that's something that everyone should understand as an LP, that there is a possibility, if you want to exit your LP position, there are more options today than there were 5, 6 years ago.
Yeah, and the discounts aren't punitive either. That's the interesting thing.
I totally agree. I mean, 2 decades ago, I mean, even 1 decade ago, 5 years ago, some of these strategies did not exist. So we had senior debt, we had the unitranche, we had a long time ago some mezzanine, but this market became extremely diverse and super interesting, which is good for everybody. And you mentioned about numbers like 1 or 2 trillion as market potential. Don't forget that the European banking sector is approximately 35 trillion. So even if there is a bit more shift, like 2 trillion, we are still at the beginning of the journey in comparison with the US, and how I personally envisage this avenue going forward. So let's talk a couple of minutes, like really have one sentence time for. What are your predictions for 2023 in terms of market developments? Just very briefly.
Yeah, but I think as a junior debt provider, what we see is lower senior debt ahead of us, and pricing going up. So I think it's a pretty good mix. So I think it should be a pretty good year for us in terms of risk return.
Okay.
If the deal flow is there.
So extremely good vintage.
I think so. Yeah.
Okay.
Usually in low in the cycle, those are the best vintage that you can find.
No, I will definitely echo that. From a sponsorless transaction point of view, we do benefit, and we see that on a number of transactions we're looking at, from a valuation mismatch between buyers and seller, where quasi-equity can bring some solution to the table. For sponsor deals, we can plug the gap in low leverage structure, as you mentioned. And from a return standpoint, we do benefit from the rising interest rate, because we do a bit of cash or capitalized interest or fully capitalized, but they are based on Euribor, right? So we are benefiting for the current environment.
Very good. Francesco?
Well, I think you can gather I'm fairly positive. Any LPs out here are struggling with a denominator effect, and so there's going to be a lot of fund positions coming to the market. And whereas in private equity secondaries, there's sort of 2 years of investments in terms of capital waiting to be deployed, we've got 3 months. And so it's a very interesting market to be in.
Thank you.
Yeah, I think similarly, interesting risk returns, denominator effect. For us, we also deploy a lot at the fund level of managers. Exits are delayed. That proves to be a real deal catalyst for 17 Capital to deploy capital. So it's, I think a very interesting and positive market environment.
Thank you. Avik?
Yeah, look, cautiously optimistic, I would say. I think, again, to what the other gentleman mentioned in terms of deal flow, I mean, we have extremely good deal flow, especially because that valuation mismatch is a discussion that we can have more actively now, I think, relative to some traditional private equity funds. Having said that, it is obviously a challenging and choppy environment. So obviously, we're always keeping a very close eye on the portfolio, and I think that is going to take a lot of our time as well, of course.
Somebody said, very interestingly speaking, the best investment opportunities exist when there is no capital on the market, yeah? Funny enough, but please join me to thank our panelist for his excellent contribution. I really enjoyed it. It was a very diverse panel. Thank you, but I am pretty sure that they are available for further questions, so thank you so much. Thank you.
Thank you, Gabriela.
Thank you.
Thank you.